Says it's time to go, and he's got me going a minute early, so I'll bill UCF for that. All right, so good morning, everybody. Glad to see everybody back. Hope you had a good Labor Day weekend. Hope you were safe. Hope you didn't get into any trouble or anything. Stay out of trouble. Gosh, it kills me when I see UCF students in trouble in the news. Don't do that. Don't do that. So, all right, I don't really have all that much in terms of announcements for you. Today we are going to, we just have a little bit left in chapter 2, so we'll finish that up. We should be able to get through all of chapter 3 today because it's not really difficult. So we should be able to get through all of that today, which means that this afternoon I will go through the chapter 3 homework, and I'll assign that this afternoon. So it'll probably be due like next Tuesday or something like that. But I should be able to do that today. We'll start chapter 5 on Thursday, and your first exam will be next Thursday. So it will open up. It will open up next Thursday. So that's our general schedule. I got an email about this. In fact, I just found this out like 5 minutes ago. I need to adjust my syllabus, but for taking the exam, of course you can take it here in the testing lab, but the regional campus sites where you can take the exam is Sanford, Cocoa, Valencia West, and Osceola. Okay, I have on my syllabus Daytona. And that's not correct. So Osceola is the 4th site. All right. So those are the sites. Somebody had emailed me about that. So there's your answer to that question. So those are the 4 sites. But if you take it at a regional campus site, you need to make an appointment. Okay, and I believe your appointment needs to be at least 24 hours in advance. So definitely don't procrastinate on that. If you make an appointment and then don't show up, I'm not sure what the penalty is for that, but I'm sure that there is a penalty because I'm sure that's not going to make them very happy at all because they're holding a spot that somebody else could take. So I need to, in fact, Kelsey, if you will, remind me, send me an email and remind me that I need to update that on the syllabus, please. So yeah, we just found that out like 5 minutes ago. So again, you take the exam either here or Sanford, Cocoa, Valencia West, and Osceola are the 4 regional campus sites. And I have the link on Canvas and on my syllabus to that, so you'll see that on there. Yeah. In fact, I'm also trying something new this morning. I have a second mic up here, so when you ask questions, what I'm going to do is I'm going to point the mic in your direction, and we're going to see later today, we're going to watch the video and see if that actually helps come through on the video. I suspect it may not because the mic it's unidirectional, so it's just for a limited distance, so I might be able to pick him up okay, but way in the back, I may not, but we're testing that today, so we're going to see how that works. So, questions? Yeah.
I was just going to say there's actually no penalty if you don't show up. I actually looked it up.
Don't say that. Don't say that. Did y'all hear that? Yeah. Now he said there's no penalty for not showing up at your appointment on the regional campus. First of all, that's very rude to do that because you're taking up a spot that someone else could take. Second of all, I know the testing lab manager out there very well, and he's very, very good. If it were me, I'd make a penalty because that don't don't say that. But apparently, there's no penalty. And let's see. I thought there was one other thing. Let me see what the standard announcements are. Got that. I know what it was. I've been kind of surprised that we haven't received more emails than we have, and I was trying to figure out why that is. And what I've been hearing is that apparently the Facebook page is very active in this course, and you guys are doing a lot of communication on that with the homework and such, and that's good. Okay, that's good for you guys to talk about it among yourselves. It's like a virtual study group, although I'm always more in favor of the face-to-face, but that's fine. So I just wanted to kind of give you guys some kudos on that. All right, so that's a good, that was good, and that made me happy to hear because when we weren't getting the emails, I'm thinking, well, either they understand everything or they're absolutely completely lost and don't even know what to ask. And apparently neither one is the case. So kudos on that one. Also, just a reminder that The videos close for each given week. The videos close at 7 on Thursday morning the following week, so you have a week or so to view the videos. Again, I've said it before, I'm going to say it all semester long. The reason for that isn't to be mean and nasty and try and make your life miserable, it's to give you encouragement to not fall behind. That's the worst thing you can do in any class, but especially in accounting classes, to get behind, okay? So that's the purpose for that. Also, if you do need to email us, which you're welcome to do, I mean, that's why we're here, make sure you email us at the acg3173@ucf.edu. If you contact us by another means, then you'll receive a reply that says something to the effect of, please email us at acg3173. And that's just because we need to control how we get the incoming information, because there's just too many ways for you to contact us. Okay? And I think that's it. Questions? Other questions? Yeah. Once, twice. Okay, good. Then let's go ahead and continue on. The market's not open yet, but I did see that it's supposed to be opening higher. I guess the futures are higher this morning. I actually didn't have a chance to look at the quotes. So, all right, where are we? Should we talk about? Okay, so last time we were talking about other comprehensive income. What is the purpose of other comprehensive income? The purpose, or why is it important? That'd probably be for us decision makers. That would probably be the more interesting question. Is the other comprehensive account, more specifically the accumulated other comprehensive income account? Why do we care as decision makers? Why do we care about that account?
Was that the one that you said isn't included in net income? So if you only look at net income, it wouldn't show the whole story?
Yes, that was the one that I said was not included in income. So you're asking the question and answering it at the same time. Yeah, you're exactly right. The other comprehensive income account is off the income statement. Okay, so it's not included in net income. Therefore, it's also not included in earnings per share. Yet, it reflects changes in value. Okay, it reflects changes in income. Okay, but here, this would be a good exam question. If it reflects income, then why is it not included on the income statement? You have an item in other comprehensive income, and what I just said was it reflects income, but yet it's not on the income statement. Why is that? Yeah. I'm already giving up on that microphone deal. Close. He said it's not measured yet, but close. Yeah.
It's not directly related to business. It's like maybe from an investment or something like that.
Tricky way to say that. She said it's not related to business, but it's related to an investment. But the investment was bought by the business, so it is.
Well, not the normal course of business. Selling products or services.
It would probably be fair to say that most of the time, that's a tricky statement. She said it's not related to their normal business. I'd have to think about that. I'd have to think about that one a little bit, and I'll tell you why after we sift out the answer. If it reflects income, why is it not on the income statement? That's the question. Okay. The answer is, remember we went through this last time, that on the balance sheet, things are recorded as they occur. On the income statement, they're recorded when they're realized. So this other comprehensive income reflects income that has occurred, but they haven't received anything yet. It hasn't been realized. Okay, the example I gave you last time was marketable securities going up in value. Okay, well that occurred. They did in fact go up in value, but they haven't sold them yet. So they haven't realized anything yet. All right. So therefore it's not on the income statement, it's recorded in other comprehensive income. Now the reason I was hedging on whether or not it's their ordinary course of business is because one of the items that would be in there is foreign currency. So businesses doing business overseas, and they therefore own foreign currency, as the value of that fluctuates, that would be in there. I I guess it's kind of a matter of semantics as to whether or not we would call that part of their ordinary course of business. Okay, but that's why I was kind of backing up a little bit on your answer. Okay, so that's where we left off. And to the point at the beginning of all this, the reason that I think this is not only important and interesting for us is that it's not included in earnings per share. Okay, and all of you know that companies live and die by their earnings per share, and that's what most people are focused on. So us as decision makers, if we understand something that maybe everybody else doesn't understand, then that gives us an edge. Okay, I think I mentioned something last time to the effect of, well, a company releases its earnings per share, and it's they're below expectations. So everybody's selling the stock. Okay, but perhaps nobody's looking at what happened over in the OCI account. So while it may be true that earnings per share were lower than expected, if you take a look at what was going on in the other comprehensive income, maybe there was a lot of income, maybe that was unusually high. So while everybody else is selling the stock, we as investing decision makers are saying, no, that's not valid because they have all this other income in here that's not included in earnings per share. And therefore, while everybody else is selling, we're buying. Okay. All right. So that's where we left off last time. So the rest of chapter 2 is really it's easier than that. All right. They go through the accounting principles by which financial statements are prepared. So make sure you review. I know you've seen all of these before, so make sure that you go through and refresh your memory on these. I want to point out a couple of that are either important to us or interesting. Of course, remember the going concern concept, which tells us, and don't say the presumption that the entity will continue. Well, the going concern simply means, yeah, that the business is going to have an infinite life. We assume that the business is going to have an infinite life. All right, which is interesting because that's why we have these financial statements broken down into periods. Okay, if you were going to go start a joint venture, all right, where you were going to go drill oil or something, and the business was only going to last 2 years, then generally speaking, you really wouldn't have to go through all of the things that we're doing in this course. Okay, you start the business, all right, you run it for 2 years. At the end of the business, you capture all the financial activity that happened during those 2 years, and that's it. End of story. Okay, but because the business, because of the going concern concept, where we assume a business has an infinite life, then that's not practical. That's not realistic. Therefore, we need to cut that infinite life into segments. Okay, into periods, and that's where the gap and all this timing issue stuff pops up. That's why we do this. Okay. So we got that. Let's see what else we got here. The accounting period is what I was just talking about. A big one for us is the matching concept. Okay, that's probably the main driver of the issues that we deal with in this course. All right, and the matching concept is simply the idea that to most properly reflect the underlying economic reality, then generally speaking, what we want to do is we want to record expenses in the same period from which the revenues for those expenses are derived. Okay, so said another way, the reason a company incurs expenses is to generate revenue. I mean, the ideal business would be a business where you have maximum revenue and zero expenses. That'd be the ideal business. Okay, but of course that's unrealistic. All right, and of course no company wants to spend money. Okay, but you have to spend money. Okay, why? Well, to generate revenue. Okay, so matching is matching the expenses in the same period that generates the revenue. Okay, so that's probably the single biggest concept we deal with in here. Accrual accounting, of course, we've talked about that, so you know what that is. Materiality, I've mentioned this before. Materiality. Let's see how they define it. Okay, so they give you a definition here, but I gave you another one. How else could we define materiality? And it's not really a different definition. It's kind of saying the same thing a different way. And I had mentioned this before. I think it's been a couple classes, though. Okay. Yeah?
Kind of like the whole point of
Okay, I wouldn't disagree with that. The things they're doing, they want to make sure there's a benefit to doing those. So I wouldn't disagree with that. But what I had said before about materiality is materiality can be defined as whether or not a reasonable user's decision would change if they had the information. Whether or not a reasonable user's decision would change. And one of the key words there is reasonable, because not everybody's reasonable. Okay? But whether or not someone's decision would change as a result of the information. And I don't remember how this came up before, but I think it was probably something along the lines of a company with $100 million or $20 million in accounts receivable. Okay, and then at the end of the year, they find out that $1,000 in accounts receivable was actually misclassified. Okay, well, that is technically an error, but $1,000 on top of $20 million receivables, that's not going to change a reasonable user's decision. Therefore, it's not material. Therefore, there's not really a benefit for the company to go track it down and correct everything. Okay, so financial statements, and when we get to the point to where we look at the auditor's report later in the course, you'll see this. They say the unqualified opinion, which is what you want to see on an auditor's report, is that their opinion is the financial statements are prepared according to GAAP in all material respects. In all material respects. So again, that might mean there might be $1,000 that's not correct, but it's immaterial. So it's not worth the benefit, isn't worth the cost. Okay? All right. A biggie is conservatism. Okay? I understand what's written up here. Somebody tell me in plain English how the conservatism principle applies to financial statements. Yeah.
When you expect the worst, you can, like, instead of highballing and getting, like, a bigger, like, essentially you write, in managerial accounting you predict a lot of times.
Okay.
So, by making more conservative predictions, you can decrease costs, specifically a manufacturing process.
Okay, he's talking about making predictions from managerial accounting and making conservative predictions, which I wouldn't disagree with that. I didn't see whose hand came up first. Forgive me. Yeah.
Underestimate your numbers, that way when it comes to it, you're not.
Underestimate the numbers. Okay. Yeah.
You kind of set like lower expectations, so like when the numbers come, it can be either there or higher.
Set lower expectations. I think that would probably be more financial analyst might do that. The company issuing the financial statements, I don't know that they would do that. But the point is on the point of that's on point. Was it? Yeah, in the tie. Under promise, over deliver. All right, I like that. All right, one more. Preparing for the worst case scenario. Okay, I understand where all of you all are coming from, because you're coming from a prediction standpoint, okay, from a forecasting standpoint, which is good. Okay, with respect to financial statements, the conservative principle, really what that means is that when a company has a decision to make as to how something should be presented, okay, and it's not real clear how it should be presented, then what they should do is basically do whatever will make themselves look the worst. Okay? Make themselves look whatever's the worst. Because remember, the purpose of the financial statements is to... Now with all these people, one person knows it. Oh, come on.
What's the question? Most properly reflect the economic reality of the...
Thank you so much for making my life worth living again. Thank you. Okay. To most properly reflect the underlying economic reality, but, and it's going to be on the exam, by the way, but as you'll see as we go through the course, in fact, this is one of the points of the course, is it's not always clear which you should do, and also then there are choices. I mean, probably the most obvious example is inventory. Okay, you guys know that when a company is presenting its inventory, they have several choices they could make, generally speaking, forgetting about IFRS for a minute, but they have several choices. Those would be FIFO, LIFO, average cost, and we'll talk about that when we get into, I believe it's chapter 6, okay? So they can present them different ways. All right. So conservative simply says that to the extent there's a gray area, okay, then they should do whatever makes themselves look the worst. All right. Now, I didn't say that's what they always do, but that's what they should be doing. Okay, so those are, like I say, make sure you read through the rest of those principles. Those are kind of the biggies for this course as far as I'm concerned. This stuff we've already talked about, accrual versus cash accounting. And the final part of chapter 2, I believe, well, actually, there's one more part. I had mentioned this, I believe, the first day of class, but I just wanted to emphasize that even though the purpose is to most properly reflect underlying economic reality, the financial statements are full of estimates, okay? So the financial statements are just an estimate of reality. All right. I think it would be fair to say that one of the major uses of the financial statements is to try and attach a value to the company. For someone either trying to buy the stock or buy the company outright, maybe the company itself trying to decide whether or not they're going to reissue stock or buy back stock, that kind of stuff. Try to attach value to the company, and the best that they can do is estimate. That's the best they can do, and we'll be seeing that all throughout the course. Okay, so just a reminder of that. Something else that's interesting here, and we'll see this, forget where, this will come up in one of our future chapters, is the idea of off-balance sheet financing. Okay, we've talked about assets enough to where you guys know or should know that assets are resources that are expected to pay future economic benefits, right? Well, I've always felt this way, and I'm sure that every reasonable person would agree with me, of the accounting crowd. One very, very valuable asset that just about every company has that is not on the balance sheet is its employees. Okay. But the reason it's not on there is because we can't really quantify it. You know, we think our employees are better than someone else's employees, and we may very well be correct, but how do you quantify that? Okay, the only way I know to do that is to pay them more, which, by the way, is a good piece of business advice. One of the things that I learned in my business experience was if you have really good employees and they really are the best in town or whatever, there's a very simple way to keep them, and that's to overpay them. Because if you overpay them, they're not going to be able to go anywhere else and make that same money, so they can't go anywhere. So you got them. So maybe we could quantify it that some way, but that would be more your managerial accounting stuff. That would be more your internal reporting. All right. And I've always wanted this. At the risk of getting too far on a detour here, but one of the things that I always thought about doing, and I have no plans to do it, is a McDonald's franchise. Okay, you stick up those golden arches. Everybody, so they're like a magnet. Okay, everybody comes to that. But it always seemed to me that a good business plan would be to open up a McDonald's franchise and then hire, really good employees and overpay them, and pay them more than they can make at any other franchise or any other fast food place, and overpay them. You'd probably need fewer, because they'd be more efficient, they'd give more customer service, which I would think would increase revenues because people come there. So now you got increased revenue, decreased expenses. So I don't know. If any of you run with that idea, I get 10%. So I want a piece of that. But all right, I don't know if I hit the lottery and win $10 million, then maybe I'll go and try it if I can afford to lose the money if I'm wrong. But before then, I'm not. So all right, the last part of chapter 2 just mentions the annual report, and this is something that you should be familiar with because every company at the end of the year is going to issue an annual report in addition to their filings with the Securities and Exchange Commission. Most every company does. I guess some of them don't, but most of them will issue annual reports, and it's just a communication from the company's management to the shareholders and other interested parties about the results of the year and what they expect for the future. Okay, and that's where, it came up a little while ago here, and we talked about this the first day of class. I kind of, when we start thinking of managerial accounting as future-oriented and financial accounting as historical-oriented, I kind of have problems with that because they're both using historical information, and they both use that to try and project the future. So, you know, I'm not going to put that on the exam, but I have problems when they say things like that. So, what you should do, and you might have already done this with Facebook, so I was using Facebook as an example the other day, but what you should do is pick a company, okay? And all you got to do is Google that company annual report, okay? And you will find at least one of their annual reports. It may not be the most current, or you can go to the company itself, and if you go on their website, you need to search for investor relations, okay? And sometimes it's kind of hard to find. It's easier to Google. Sometimes it's kind of hard to find, but go on there and just pull up a company's annual report, and you'll see all sorts of information in there, one of which is the financial statements and the notes to the financial statements. Okay? All right, so with that, that wraps up chapter 2, which should have largely been a review. There was probably some new stuff in there, but for the most part, that should have been a review. Make sure that you do the review homework that I assigned. I assigned a homework called review material. So make sure you go through that. I did that with the blessing of some of the professors who teach the prerequisite courses to this, both here at UCF and at some of our partner institutions. So they all agreed that it's a fair review, and it doesn't really affect you guys. But I'm going to, for whatever it's worth, I'm going to be beefing that up over time, and I'm actually going to start releasing that the very first day of class. Okay, so but not that it affects you guys. So questions about chapter 2? Questions? I'm being sincere. Questions? Okay, chapter 3. So let's go ahead and start with chapter 3 here. And in chapter 3, what we're doing is looking at some of the basic information that decision makers use to make their decisions. Okay, and it's all on ratio analysis. You'll see this over in 3403 as well. I don't know if you've gotten that far in the course over there yet or not, but you'll see some similar information there. So chapter 3 introduces you to ratios. Chapter 11 in the book is a more comprehensive discussion of ratios. If you'll notice on Canvas, I have posted on there chapter 11 as suggested reading at this point. So what you should do is, in addition to studying chapter 3, go through chapter 11 as well. All right, I'm not gonna test chapter 11 in detail per se, but some of the ratios that I'm introducing now, I pull out of chapter 11, okay, because not all of them are in chapter 3. All right, so make sure you take a look at chapter 11, at least with respect to the ratios that I have in here. And what we're going to be doing is I'm introducing these ratios now and pretty much for the rest of the semester as we're looking at all of the decisions for the various parts of the financial statements. A common approach will be, okay, well, if this accounting decision is made, how does that affect that ratio? Okay, because that will drive the decision that's made from that ratio, okay, which is what we're looking at as decision makers. Okay, so with that, chapter 3 is really about financial ratios, which the financial ratios are just expressing one part of the financial statements against another part of the financial statements as a ratio. Okay, I mean that's very simply what it's doing, and I always look at ratio analysis as part art and part science. Okay, the science part of it is that given a question or given a decision to make, some ratios would clearly be more useful than others. Okay, but the art part of it is you can do whatever you want. Okay, as a decision maker, you can do whatever. There's no law that says you have to use the current ratio over the acid test ratio. There's no law that says you have to do that. So ultimately, you can do whatever you want. The only requirement that I'm aware of, at least for our purposes, is earnings per share, which is required to be reported on the income statement. Okay, so that's the only ratio that I'm aware of that is actually required to be reported. Now, when you start getting into the banking industry and you start getting into some of that stuff, there's probably some requirements in there, but we're not going to get that specific in this course. So for us as, shall we say, general decision makers, you can do whatever you want. Okay, so that's the art part of it, in my opinion. All right, so. Okay, so there's two ways that we can use ratios. And I always look at it, let's see if I can get my technology working right this morning. Okay, so two ways that we can use ratios, and I always look at it this way. All right. One way is we can look at the same company over time. So your business, okay? You started your business, you're 6, 7, 8 years down the road, and you want to spend some time analyzing what has happened in the past so that you can adjust and for the future, okay? That is called trend analysis. So looking at the same company over time is called trend analysis. And just a reminder, my handwriting isn't great in the first place. It's double hard when I have to write on this and I can't rest my hand to anchor it. So I'm going to apologize all semester, but I'm doing the best I can with what I got here. In fact, next time I may try my iPad because I think that'll work. Might work the best. But anyhow, looking at the same company over time is what's called trend analysis. For those of you who remember your quant tools, it's also called well, it's used in regression. It's used in forecasting. Time series analysis. Okay, so trend analysis, or we can look at different companies at the same point in time. Okay, so again, you're looking at your business, you're looking at what happened last year, all right, and you want to compare that to your competitors. Okay, well, how profitable were we compared to our competitors? How liquid were we compared to our competitors? How risky are we compared to our competitors? So forth and so on. And so if we look at the same ratio for different companies at the same point in time, then that would be called a industry analysis. Industry analysis. Okay, so two ways we can use ratios. Okay, one is a trend analysis, also called time series analysis. Okay. The second way is an industry analysis, also called, anybody? Cross-sectional analysis. Okay, I'm just on the exam. I mean, I'll just have trend or industry on there. I'm not going to ask you those stuff, but just for the quantitative types among you. Okay, it's also time series or cross-sectional analysis. Okay, so those are kind of the two approaches to ratios. And ratios normally, at least in my opinion, usually don't have a lot of meaning all by themselves. Okay, where ratios really gain meaning is when you compare them to other ratios. Okay, so for example, let's say one of the ratios we'll see here in a minute is the current ratio. Okay, the current ratio is calculated how? Anybody know? That's supposed to be in R's. Yeah. What kind of assets? Yeah, current assets divided by current liabilities. Okay, you'll see this again in a minute. All right. So that's the current ratio. Okay, it's a measure of liquidity. Okay, it's a measure of how well a company is able to pay its bills. Okay, so let's say that your current ratio is, for this year, is 1.2. Okay. Is that good or bad? Why is it good? Okay. Yeah, okay. Yeah, in this particular case, which probably isn't the greatest example, but we could argue that it's good simply because we have more current assets than we have current liabilities. Okay, so from that standpoint, we could argue that it's good, but how good? Okay, well, it's kind of, all by itself, it's kind of hard to make that judgment. But let's say that now we look at our nearest competitor, and their current ratio is 1.5. Okay. Now, what can we say about our liquidity? Yeah, even though we have more current assets than current liabilities, we're not as liquid as our nearest competitor. And assuming we desire to be, then that's bad. Okay. But maybe our current ratio last year was 0.9. Okay. So now what can we say? Yeah. Even though we're not as liquid as our competitor, okay, we're more liquid than we were last year, which is okay. And maybe their current ratio last year was 1.6. Okay. So even though they're more liquid, okay, they're going in the wrong direction. Okay, they're less liquid than they were last year, and we're less liquid than they are now, but we're becoming more liquid. Okay, so my point of this is that ratios usually don't contain a lot of meaning until you start comparing them to other ratios. And even if they do have some meaning, they gain an even richer meaning when we start comparing them to other ratios. Okay. Questions so far while I catch up with my notes here? Questions? Yeah.
How would you find out the ratios for the other, the numbers for the other?
You'd find the ratios from the other companies off of their financial statements.
All right, so they have to release those to the public?
Well, they release the financial statements to the public. So they don't have to release the ratios to the public, but they release the financial statements to the public. But those financial statements are only going to contain so much detail.
That's
Okay.
what I was wondering, like if they would actually give their real number, their numbers out completely in detail for other people to see them.
Well, yeah, and he's questioning how much detail they're going to give in the financial statements, and they're going to. One of the principles of financial statements is adequate disclosure. Okay, so that in conjunction with materiality, they are supposed to release as much detail as a reasonable user needs to make their decision. Which is why sometimes you'll see things broken out on a separate line item on a financial statement for one company, but not for another. Because on that one company, it's a significant portion of their business, whereas on the other one, it isn't. But part of our task as decision makers, as external decision makers, is to take their information and infer this stuff from it. Okay? That's actually what business analysis is all about. Okay? Because they're not going to, external users will never have as much detail as the internal users. That's not going to happen. Okay, so as external decision makers, our task is to try and infer what management is doing. Okay? So, and probably a classic example of that is if we're looking at maybe we discover this through ratio analysis or what have you, but every year maybe their cash balance is going up and up and up and up every single year. Okay. Well, they may not disclose in the annual report that why they're doing that, but something we might potentially infer from that is, well, if they're continuing to build up their cash, they must have a big purchase that they're getting ready to make. And for a for-profit business, there's only one reason, ultimately only one reason to make a purchase, and that is to increase the value of the business. Increase the value of the business. Okay. So even though they're not saying that, that's something we might infer from the information that they do give us. Okay? All right, good question. All right, so starting off with the basics here. Okay, rate of return ratios. This is, I like your book, which is of course why I chose it. One of the things I wish they wouldn't do is they throw around they throw around the ratio return on investment a little too loosely. Most of the time when the book refers to return on investment, they're referring to return on assets, okay, which I'll show you in just a second, but not always. All right, and this is something I'm actually kind of correcting this in the homework, so I'm actually going into their software and changing that. And that's a very time-consuming process because well, for a number of reasons, one of which is their software is very buggy. So half the time when I go in to change something and I try and go out, it crashes on me and I got to start all over again. All right, so I'm chipping away at it as best I can, but you're still, just be aware as you're going through the homework all semester long. Okay, when they refer to return on investment, usually they're referring to return on assets. Not always. Okay, so rate of return, I think you guys understand in concept what a rate of return is. It's whatever you receive divided by the amount you invested, okay, the amount of return. Make sure you are aware of the interest calculation. We're going to talk about this quite a bit in Chapter 7. We touch on it in this chapter a little bit, but we're going to dissect that quite a bit when we get to, I believe it's Chapter 7. So make sure you're at least generally familiar with the formula right now. I equals PRT. Okay, I equals PRT. And you'll see this when we get into Chapter 5 here, if not today, on Thursday. All right. All right. So this is what I was saying a minute ago. The return on investment, okay, or they're talking about a rate of return. That's a general concept. All right, and I think the book uses it too specifically, okay? But return on investment is a general concept that just simply refers to, hey, you invested a certain amount of money, okay, in order to receive a return. So return divided by investment is your return. All right, if you invested $100,000 and received a $10,000 profit on that, your return on investment is 10%. Okay, that's all it's referring to. So getting a little more specifically, we have two return ratios that we're going to be looking at all semester long. Those are return on assets and return on equity. Return on assets and return on equity. And by the way, you need to know all of these ratios for the exam. By the time if you actually do the homework, which it sounds like you guys are doing, but by the time you do all the homework, you'll know the ratios anyhow. Right? But just for the record, you need to memorize these ratios, and these are very common ratios. Okay, it's hard to have a financial conversation about a company without hearing one of these ratios pop up. All right, so very common ratios. So these two ratios are measures of profitability. First one, your return on assets, and this is net income divided by average total assets. Average total assets. So that would be beginning assets plus ending divided by 2. All right. But what I really wanted to point out here is notice that this is from at least the way I look at it, this is a return on investment or a rate of return from the company's perspective. Okay, because like I just said a minute ago, there's only one reason, or similar to what I just said a minute ago, there's only one reason ultimately that a company purchased assets, a for-profit business purchased assets, and that is to, increase value, okay, which is generally measured through profits. All right, so this is a measure of return from the corporate perspective. Okay, hey, we purchased these assets. What kind of a return are we getting on our purchase? Okay, so that's from the corporate perspective as opposed to return on equity, which would be more from the shareholder's perspective. Okay, so they're not the corporation, they're the ones that purchased stock in the corporation as represented by the equity. And there's only one reason a investor purchases stock, and that's to get a return. Okay. Now, when you purchase stock, and by the way, I should pause right here. What is stock? What do you mean by a piece of the company? Yeah, they do issue X amount of stock, and I know what you're saying. Yeah, help them out. Yeah. Stock in a company represents ownership in the company, okay? Which is, I know what you meant by a piece of the company, but it represents ownership in the company, okay? And there's only one reason to do that, and that is to expect a return. So when you purchase stock, whether you realize it or not, okay, what you're purchasing is the net income from the business, because as a shareholder, you have a right to your share of the net assets, basically. That's getting a little bit ahead of what I wanted to, but that's the gist of it, all right? So this is a basic measure of return to the shareholders. To the shareholders, okay? So again, and I want to emphasize this because they do it quite a bit throughout the book. In fact, they do it all throughout the book, is they're using return on investment in both a general sense and a specific sense. So be a little careful, because when they talk about return on investment, most of the time what they're referring to is return on assets, okay? But not always. A little later on in the course, you'll see sometimes they refer to it as return on a marketing project and other things. All right, so just be aware of that, and I have corrected that in some of the homework problems, but not all of the homework problems. Okay, and I shouldn't say corrected. I have made it more clear in some of the homework problems, and I haven't gotten around to some of the other ones yet. Okay, so those are two basic measures of return. Okay, rates of return. All right. Some basic measures of liquidity, which is really what I was talking about a minute ago, is working capital, current ratio, and acid test ratio. The acid test ratio is also called, very good, quick ratio. All things considered, that actually came out pretty good. Acid test ratio is also called the quick ratio. Okay, so you'll see that either way, so you should know those are simply synonymous terms. These are all measures of liquidity. In other words, how well a company can pay its bills. All right, and I was just talking to you about the current ratio a minute ago, which is current assets divided by current liabilities. What is working capital? Outstanding. Working capital is the exact same information, except instead of dividing, you're subtracting. Okay? So working capital is simply current assets minus current liabilities. Current ratio is current assets divided by current liabilities. Okay? So the mathematical difference is easy and kind of boring, but the interpretation is significant. Okay, because notice that, or be advised that when you divide, then that adjusts for scale. Okay, so for example, let's say you start your business and it's a hardware store. Okay, you have a local hardware business here. All right, well, if you want to compare your local hardware business to Home Depot, okay, it's going to be challenging because obviously, I presume, Home Depot's a heck of a lot bigger than your business, okay? So it's not directly comparable, all right? And if you're trying to determine how liquid your business is compared to Home Depot, all right, and you try and do that by working capital, it's probably going to be next to impossible, all right, because of the size difference. You know, your current assets may be $15,000. I don't know what Home Depot's current assets are, but it could be $20 million. All right, so the size of your working capital will be different, but if you take the same information and express it as a ratio, okay, now it's adjusted for scale. Okay, so now you can compare your local hardware store to Home Depot. Okay, and that's a big advantage of ratios, and you'll also see this when we get to common size financial statements. Okay, so we already said this. So there's your working capital, assets minus liabilities, current ratios, divided. Okay, they're saying a rule of thumb of 2 current ratios. So every dollar you have in current liabilities, if you have $2 in current assets, that's a good measure of liquidity. Okay, that sounds fine by me. Whether that's, I think that would probably be driven more by the industry, because some industries are going to be more liquid than others. So whether or not it's exactly 2, I think we could open for discussion. Yeah.
So you use working capital to compare like similar sized businesses, while current ratios is for like a kind of the same business?
Yeah, I think that would be a good statement, is working capital would be more meaningful or more comparable for businesses of the same size. Okay, and that might be your business, okay, where you're looking at your business this year from last year. All right, so it probably hasn't significantly changed in size, so working capital might be more meaningful. But if you're looking at your business as compared to 20 years ago, then it might not, because hopefully your business is much larger now than it was 20 years ago. But yeah, I wouldn't have a problem with that. So working capital would be more meaningful for businesses of similar size, okay, or the same size. Okay. All right, so current ratio. Okay, and then the acid test ratio is really the current ratio, but all we're doing is we're looking at more liquid assets. Okay, because remember, items on the balance sheet are listed in order of liquidity. Listed in order of liquidity. Okay, so the current ratio was just taking all of the current assets, including inventory, dividing by all of the current liabilities. Okay, that's fine, no problem. The quick ratio, or the acid test ratio, is just focusing on cash and accounts receivable. Okay, because those are the more liquid current assets. Okay, so this is a more specific measure of liquidity, and it actually makes sense because if a company could sell inventory at will, then again that would be like an ideal business. Okay, so it makes sense that if you wanted to get a better feel for the liquidity, you would take that out and focus just on the cash. Cash is liquidity, and the receivables. Okay, which will probably be liquid in 30 days. Okay. All right. So those are three of our liquidity ratios. Okay. Couple of my favorites. Okay. Measures of risk. I'm a finance guy, so I'm always interested in risk. And I believe these are two ratios that I pulled from Chapter 11. So these may not be in Chapter 3. I don't recall, but I think at least one of them I think is from Chapter 11. But these are measures of risk because both of them measure the use of debt. Okay. This is an incredibly important concept. You'll talk about this over in your 3403 class more than we will in here, but we will talk about this, I believe, in Chapter 10. I think is or Chapter 12 maybe in this course, is risk, the use of leverage. The general idea here is that the more debt a company has, the more risky the company is. And is that intuitive? Does that make sense? Okay, why? Why is what I just said true? Higher risk. Okay, higher risk of default. Yeah, okay. Okay. The question is why, yeah.
Gives them incentive to make like a bigger change, I think.
Gives them incentive to make a bigger change?
Like if they're in a lot of debt, they would make dramatic changes into a company and try to get out of it maybe. Like something that other companies wouldn't do. They feel like safe, like in the safe zone.
Okay. I'm not sure how to summarize that, but he's talking about the more debt they use, the more they would have incentive to change their business. So one more.
Any income that the company makes is going to be going back to those debts.
Okay.
But since they're in so much debt, there might be a sense they're not making.
Okay, close enough. Yeah, income to debt, which, by the way, when banks analyze whether or not they're going to issue loans, one of the major ratios they use is income to debt ratio. For that exact reason. So in essence, what she said was that the more debt a company has, the higher the payments. Right? And they may not have enough income to cover those payments as they issue more and more and more and more debt. Okay? So that's one reason why more debt leads to a more risky business, just like you personally. Just like, I mean, if you apply for a dozen credit cards and max out all of those credit cards, are you in a relatively risky personal financial decision? Of course you are. Don't do that. I used to have does the name Gary Yeoman mean anything to anybody in here? Gary Yeoman. He's been a car dealer in the area forever and has several dealerships. Well, his daughter was in my 3403 class. It's been several years ago. Poor girl. She grew up, in the car business, and I'm fascinated by car deals. I used to inundate her with questions every single week. I felt sorry for her. But after she got out of my class, she actually used to come back and guest speak in 3403 when we talked about car payments and that kind of stuff, and she'd come in and guest speak about car deals and the little intricacies and so forth and so on. But one of her major points was always, don't start out don't start out with a lot of debt. She said you'd be amazed at how many 19, 20-year-olds, and sometimes younger than that, coming in to buy a car, and their credit is already destroyed because they've gotten all these credit cards, they maxed them all out, and then defaulted on them. Okay, and they want to go buy a car, and they're looking at 13, 14% interest rate on a loan because nobody else will loan them for less than that. So don't do that. So hopefully you paid attention in Paul Gregg's personal finance class. Pay attention here. Pay attention in 34.3. Don't do that. So okay. So these are measure of risk, and really this is the same information just presented two different ways. I mean that's really all this is right here. The first of which is debt to equity ratio. Not a whole heck of a lot to memorize here because the debt to equity ratio is simply total debt divided by total equity. Of course, the higher the ratio, the higher the ratio, the more debt they have. So the riskier the business. All right, so the higher the ratio, the riskier the business. And the debt ratio is essentially the same thing. Okay, total debt divided by total assets. Again, the higher the ratio, the more risk, because the more debt they have. This is probably a little easier to interpret for two reasons. Number one, the interpretation of this is simply the percentage of the assets that have been financed by debt. Okay? Because what we're getting at here is when a company purchases assets, there's basically two ways to do it. One is to borrow the money, and the other one is to pay for it through equity. Either shareholder contributions or through profits. Okay, so this is the percentage of the assets financed by debt. The greater the percentage, the higher the higher the risk. Okay, so that's one reason this is easier to interpret. The other reason, which really came home to roost with me when I was going through the auto bailout with another class several years ago, is that with the debt to equity ratio, if the company has a negative equity, then this ratio gets a little hard to interpret when you're looking at 3 or 4 companies that all have a retained deficit, okay? And therefore they have negative equity. It gets a little tricky to interpret that. But this one, again, percentage of assets paid for by debt. So if they have negative equity, then this ratio will be greater than 1. Greater than 1. So said another way, if to the extent this ratio is greater than 1, then that means they have a retained deficit. The more the deficit, the higher the ratio. Okay. So both of them, again, essentially presenting the same information two different ways. Okay. But in this course, when we talk about those ratios, what I want to pop in your mind is risk. Okay. All right, a very common way to use ratios analysis is called the DuPont method, or the DuPont model, which was made famous, not surprisingly, by the DuPont company. I believe it was back in the 50s. Don't quote me on that part, but it was back in the 50s. But what they're doing is they're looking at return on equity, which I just told you a few minutes ago was a basic measure of return. Okay, but what the DuPont model does is it goes beyond the obvious. Okay, to get into a richer analysis of what's really driving that return. Okay? I mean, you don't have to sit in here for an entire semester to look at two companies. One has a return on equity of 20%. Company A has a return on equity of 20%. Company B has a return on equity of 12%. Which company is better? The A with 20%. Okay? But that's a very superficial analysis which may actually not be true. Okay, so what this does is it goes beyond the obvious. Okay, so usually the first step is what we're going to do here is an algebra trick. Okay, so notice return on equity is net income divided by total equity, okay, or average. Right? And what we're going to do here is an algebra trick of dividing net income by assets and then dividing equity into assets. Okay, so notice, of course, that we can cancel those out, and that brings us back to return on equity. Right? But that is one feature of this that I do like. Okay? So what this does is it breaks the return on equity into return on assets. So notice the first variable there is return on assets. And then the second variable is risk. Okay? And total assets divided by total equity is just another way to express what we were just talking about a minute ago with debt to equity versus the debt ratio. Okay? Debt to assets. This is just another way of writing the same thing. In fact, usually the way, at least the way I've always seen it and the way that I've always used it is total assets divided by total equity is the same thing as 1 plus the debt to equity ratio. It's the same thing as 1 plus the debt to equity ratio. So what we have here is return on equity equals return on assets times 1 plus our debt to equity ratio. So what this is showing, or what this is sifting out, is that return on equity is being driven by two variables. Okay? How well the company, how efficiently the company has employed its assets, because remember the only reason the company purchased the assets was to get net income, and the portion of return on equity that was driven by leverage. Okay? And this is important because the problem here is that to the extent return on equity is being driven by borrowing, it's not sustainable because you can't borrow forever. Does that make sense? Okay. Said another way, if your return on equity is unusually low for 1 year, there's a relatively easy way to increase it, and that is to go borrow money. Okay? So a company could actually make their ROE look better than it really is. Let me put it like that. Okay? In fact, I have an example that I think pops up right now. Got to catch up on my notes here. Acid test, measures of risk, debt, basic. Got that? Yeah. Okay. So, for example, all right, let's say you're looking at two companies. Okay. So, company A, company B, and they both have return on equity of 12%. Okay. Well, on the surface, it looks like the companies are equal. It looks like both of them are doing just as well. But if you break down the DuPont analysis, which, by the way, you're not going to see on the annual report, okay? They're not going. I don't ever recall seeing the DuPont analysis on the annual report, but all the information to calculate it is on there. So we're looking at two companies, their annual reports. We calculate their ROE, 12%. Everything looks equal. But when we look at the DuPont analysis or start breaking it down, then what we find, let's just say, is the ROA for company A is 10% with their risk, let's say, of 1.2. Oh, I'm sorry. Thank you. There we go. Thank you. Okay. So ROA was 10%. Okay. Company B, ROA 5% with their leverage ratio of 2.4. Now, which company is probably in a better financial position? A. A. Okay. B is a much riskier business with lower return on assets. Okay? So far, so good? Okay, so that's kind of the first step in the DuPont analysis. Your book goes one step further, and what they will do, and you'll see this in the homework, okay, is continuing with the algebra trick. They'll take ROA, which is net income divided by assets, and they'll use sales. okay, to divide. So doing the same thing, if you take net income divided by sales, and then sales divided by your total assets, sorry about that, okay, then this together is your ROA. Okay, so what this is doing is it's breaking down your return on assets into what's called your net profit margin. And this is another part where I think your book's a little too loose. Net income divided by sales is actually usually referred to as the net profit margin. You'll see the book refer to it just as margin, which is, in my opinion, a little too general. Okay, net profit margin times asset turnover. What's called the asset turnover ratio. Okay, and then you've got your leverage. Sorry about that. That's supposed to say leverage. Okay, sorry about that. Okay. So your book likes to go one step further, which is common, by the way, and break out ROA into net profit and asset turnover. Okay. So again, the point, and you could continue on. I mean, there are extensions even from this, and this kind of gets back to the art part of ratio analysis. Is there's no law that says you have to do this, and even if you do it, there's no law that says you have to do it this way. Okay, but this is a good classic example of how you take a simple ratio and then start looking at the details of it a little more to sift out the more richer information, which gives you a better analysis. So like I say, at the beginning of all this, with ROE of 12%, it doesn't take a lot of analytical ability to look at two companies' ROE 12%. Oh, they're the same, so we're indifferent as to which one we buy. Not really, not necessarily. Okay, questions? All right, they give you an example of a trend analysis. We talked about this already. Just some examples of ways you can do trend analysis. But I do want to make you let's see. I think we've actually covered all these ratios. So the ratios that we have already talked about in here, you need to make sure you memorize those ratios. Nothing difficult about it, but very common ratios to know. Two others that didn't pop up in the slides here, and if they're not in Chapter 3, you'll see them in Chapter 11. They're activity ratios, okay? How efficiently assets are being used. All right, the first one... I'm not going to go through all that. The first one is called the account receivable turnover ratio. I'm trying to find a place to write it up here. Accounts receivable turnover. Okay. And this is calculated as sales divided by average accounts receivable. Sales divided by average accounts receivable. And similar is the inventory turnover ratio. Inventory turnover, which is, that's supposed to say cost of goods sold divided by average inventory. Wow, sorry about that. I can't, it's, and then this thing is wearing out as well. So it's supposed to say inventory turnover is cost of goods sold divided by average inventory. That's what that's supposed to say. Okay. With all of these ratios, what you want to be able to do is a couple of things. One is to be able to calculate the ratio. So, sorry about that. I meant to put this on Do Not Disturb. One of which is to calculate the ratio. Something else you want to be able to do is a basic interpretation of the ratio. So in other words, is a higher ratio good or bad? All right. And throughout the course, the reason I'm introducing some of these ratios right now is because what we're going to be doing throughout the course is we're going to be looking at, okay, the accounting decision that Kelsey and her colleagues make, okay, how do those accounting decisions affect these ratios? because these ratios is one of our sources of primary information for making decisions. Okay, so all the accounting decisions, remember I said the financial statements are full of estimates. They're full of judgments. Okay, well, based on the decision they make, how does that affect the ratio? Okay, questions? Questions? Yeah.
Like, I don't know if your program's set up, but it's easier to use that word.
Okay. No, it's not. But thanks for helping out. The board isn't working. So, but thanks. Other questions? Okay. So that wraps up chapter 3. What we will do on Thursday is we'll start chapter 5. So we'll probably get through. I don't know how far we'll get on Thursday, but probably on Thursday we'll get chapter 5 through notes receivable. Okay, so we'll probably get there and then finish up chapter 5 on Tuesday. Your exam will be on Thursday. Okay? All right, good class. Have a good rest of the day. I'll see you on Thursday. Yeah, and the board